Hello, everyone, and welcome to the Upside Ticker Talk. This is episode 15, and today is August 12th. I won't say summer's almost already over, but it feels like it's gone by very, very fast. I'm actually here in Toronto today in the studio. We moved away from Montreal for the month, but we'll be back there soon enough. Really quickly, as we always do, recapping last episode, had the pleasure of having Andre Bruno on the show, recurring guest. He's our director of ETFs here, and we talked all things Canadian ETF industry, trends that we've seen so far. We've updated on the last month of flows. We also took the time to make a kind of a special episode where we focused only on internet questions. So hopefully we answered a lot of your questions, and we always love doing that, but we decided to dedicate an entire show of getting to those questions. So very fun episode. As always, you can catch it on your favorite podcast app, YouTube, however you consume the Upside Ticker Talk. So a bit of a different episode today. So we often have ETF industry experts. Today we've got an asset management industry expert, but coming from a field that's a little bit different on the finance side. And we're actually going to take a deep dive into a great thought leadership piece that was written concerning performance. Performance matters, and fees are not basically the end-all be-all when it comes to investment decisions. So I think this is going to be very interesting for everyone listening in. I think it's a different perspective on approaching investing and making investment decisions. So with that, I'll introduce our guest, Jason Deere. Thank you so much for joining us. Jason's Director of Finance here at Fidelity Investments Canada. So once again, Jason, thank you so much for joining us, man.
Yeah, thanks for having me. Long-time listener, first-time caller. I don't know if that still applies for
I love that.
Ticker Talk, but happy to be here and happy to share the work that we did on this paper as well.
No, that's awesome. And, that's great. So you've listened to the podcast. You kind of know how this goes a little bit. Like we try to keep it a little bit less formal than what we typically do in terms of content. And I'm really looking forward to picking your brain on that paper, but it will go a bit deeper than into other subjects as well. It's very timely. Like I feel like we've heard about, fees have been top of mind for the last better part of a decade. But it seems like maybe the tide's changing a little bit. So I think it's an interesting time to be talking about this. So thanks again for joining us. Before we get started on our the meat of the conversation, if you will, as always, industry recap. So we're going to start by looking over the last month, which would be July in this case. Another very solid month in the Canadian ETF industry with about $18 billion in net new assets coming in. That brings the year-to-date total to $122 billion. If you've been following along, you remember that last year was a record year at $135 billion. So we're well on our way to outpace last year's record, which is obviously great news for the Canadian ETF industry, Canadian asset management industry, investors in general, because that means there's more and more product options out there. Very, very exciting times to be in this space. In terms of what was popular in the month of July, a lot of the continuation of what's been popular this year. Equities largely outsold fixed income securities. Not too much of a surprise considering, obviously, earnings growth across the globe, especially in North America, has been very positive so far this year. Equity markets performing very well. Obviously, a little bit of volatility at the end of July, notably coming from a bit of a sell-off from the momentum names, which are AI sensitive, and other areas like emerging markets, which have become very very sensitive to the AI trade. On the fixed income side, saw about $3 billion in net new assets coming in. It's not a terrible month, but a lot of demand for very short-term based fixed income, as we did see in the month of July. Yields continue to rise, especially on the long end of the curve. 30-year treasuries actually hit their highest level since 2007. It's not to raise any alarms. I don't think we're necessarily, hopefully not anyways, in a situation like we were in 2007. But nonetheless, it's been a very challenging time for those that are playing the duration call, if you will, in a portfolio. So more demand for short-term corporates, short-term government bonds, and a bit less so on the longer end of the curve. Other things that I had jotted down here, thematics and smart beta ETFs continued to have a pretty good month, albeit it slowed relative to June. Momentum factor ETFs, which had done super well, the ones here at Fidelity, at other firms from 2003, I'd say, until basically March and July being kind of the exceptions. Those were in outflows for the first time in a little bit, and we saw that rotate towards value factor ETFs. Last little comments that I had here, multi-asset ETFs, it's kind of like the recurring theme, but another positive month. There's never been a negative month. Hasn't happened yet. So continue to see assets going there with about 1.6 billion in net new assets. Actually, maybe a little quick shout out to us. FBAL actually hit our all-in-one balance, actually hit 10 billion in assets. So thank you everybody who's supported that product here at Fidelity. That category as a whole has been very, very popular among Canadian investors. So that all-in-one ETF category. And yeah, last comment, 16 new ETFs listed in July. And specifically interesting to the conversation we're going to have today, not a single one of those ETFs had an MER below 30 basis points or 0.3%. So a lot of net new products that are being launched in the Canadian ETF industry are more on the active or at least on the quantitative side where, the strategies maybe are a bit more sophisticated than just a market cap weighted approach and therefore commanding slightly higher fees, albeit, providing these very, very interesting kind of return profiles or risk return profiles while doing so. And now, Jason, probably unfair for me to ask you, like, what are your thoughts on all these different flows topics? But maybe on that last point, actually, is, are active ETFs gaining traction again? And is it something that you're starting to see from your perspective? And I know obviously at Fidelity, we're a big proponent of that because they're definitely not the cheapest options out there.
No, I mean, you're right. And I think the numbers that you just shared sort of speak to the transition that we've been seeing within the industry. Investors and advisors are clearly voting with their capital that that's a vehicle of choice for them. And I think asset managers are meeting that demand with newer products that can fill a different role in the portfolio than, what we maybe oftentimes thought the ETF could, which was one that's more passive, lower cost.
Yep.
We'll get into it more, like you said, but I think it just speaks to the evolution of the vehicle and more choice that can serve different purposes within a portfolio.
Yeah, no, you're totally right. I think it's at a certain point, there's only so many different market cap weighted index products that can be out there. So it's actually spurring innovation, which is really, to the advantage of investors, advisors, and all those participating in the ETF industry. So no, thanks for that. Let's answer some questions. So I picked out some questions. I was like, let's try to find some questions that are, specifically relevant to the topic today. There's a few in there that maybe a bit less so, but nonetheless, I'll ask you first, maybe Jason, from your perspective, the question that we received here is, what's the biggest investing myth people still believe?
Yeah, I mean, I guess, not to tip my hand too much, maybe we'll just start off with the idea that fees are the only thing that matters.
Yeah.
That's one that you can often hear in different circles. And I think it really kind of speaks to what we were just talking about with respect to those lowest cost ETFs and the narrative that can sometimes be out there. The problem with that, of course, is that it means that, investors and advisors might be missing one of the more important metrics to consider, which is the returns. Investment returns have been really focused with respect to certain areas, particularly in the last few years. And so maybe it's been a strategy that's worked to a certain extent, but you can fall into, I think, a little bit of a trap when looking forward if you're only focused on that. And I think that's a big one for me.
Okay, yeah, that's a very good one for sure. I'm trying to think, maybe the one that I often hear, and it's entirely due to the fact of what you mentioned, is like the momentum that's been driven by the top of the indices. And I say indices because it's not just the S&P 500. We were talking about emerging markets last month, and just basically 3 stocks are responsible for 3/4 of the performance of that index. And yes, there's 1,269 stocks as part of the MSCI Emerging Markets Index, but when a quarter of that is 3 stocks, you are inherently not as diversified as what you might think by owning it. So my big myth is that you can own one index forever and expect to get a consistent outcome to what you've seen in the past. And we often get it with regards to the S&P 500. Is like, why don't I just own the S&P 500 and that's it? It's very easy to say when you look at the last 15 years, but if you look at the 10 years before that, you would have gotten nothing. And so maybe saying I'll buy an index, okay, but maybe if you buy multiple, at least that's an option to give you more diversification. Okay. Second question. Should I buy an all-in-one ETF or buy the same underlying ETF separately for selective exit? Maybe I'll take a crack at that one. Feel free to add any thoughts because, I mean, heck, either in your own portfolio or maybe in other experience or conversations you've had, could add some thoughts there. I think so. It really comes down to how simple do you want to keep it? Do you want to be making those decisions? Do you want to be timing things? Do you want to be, considering rebalancing periods? Do you want, if it's in a taxable account, I'd say that's probably more important than a non-tax, like a registered account. But I would say that long term, if you're looking at an all-in-one ETF or buying every underlying piece, you're actually better off with the package for a few reasons. One that I mentioned, simplicity, but the other is cost. If you go out and buy the package, you're not incurring trading expenses on 18 different ETFs. You're actually doing it on just one. So you are saving basically trading expenses on that front. That said, I will say with a caveat, here at Fidelity, for example, like if you were to go out and buy the 18 components of our all-in-one balanced ETF, you're going to get the same exact cost as if you would buy, the all-in-one solution. That's not necessarily the case everywhere. So just keep an eye out for that. You might be better off buying the pieces individually.
And that's a great point. I mean, they've been designed with that intent that, what investors are receiving is what they would pay. But I think the point on cost really resonates with me when you think about things like bid-ask spread. Every time you have to go to market to rebalance, there's a lot of benefit to being able to have that more efficient through the one-ticket solution.
Yeah. No, absolutely. And even I just thinking about it again, like when I said simplicity, like what's interesting is, for example, like every day we're getting flows, we're kind of reallocating to the positions that are underweight. And so when there is a market shift or when there is a downturn, like we're actively kind of doing that without a behavioral bias, which we know sentiment can be super important when making investment decisions. So it takes away some of the, the sentimental aspect of it of like, this is down, I don't really want to be selling it, or vice versa. I don't want to be buying back something that's lagging. It takes some of that out of the equation. Okay, we got two more questions to answer, and then we get to me asking you questions. What's one investing habit that's made the biggest difference for you? Maybe we'll start with you, Jason.
Yeah, I mean, I think for myself, I'm a father newly for the second time.
Congrats.
Thank you very much. So, with that comes thinking about investing in different ways. And I think more broadly, just as I've aged a little bit and gone through more life events, you think about all of these things with different objectives in mind, getting married and saving for a wedding, saving for my children's retirement or education, I should say, saving for my spouse and my own retirement. All of these have different time horizons, different objectives. And through that experience, you really get a better sense of what your actual objective is with your broader portfolio. I think that helped crystallize for me why I'm investing more.
Yep.
And maybe different things and different solutions being the right option for each of those. Yep. Rather than it just being one sort of nebulous big, pool of trying to figure things out. It just puts a lot more context to the ultimate decisions that you're trying to make.
Yeah, makes absolute sense. Like different, you can have different holdings for different goals and different objectives. And best example of that, to your point, is I've got two young kids as well, got RESPs for them. They're investing probably a little bit more aggressive than I was when I was saving to buy my first house. So,
exactly.
No, that's a great one. I'd say for me, like one habit is just being, and it's very much a cliche, so I apologize for that, but it's like time in the market is much more important than timing the market. I used to kind of accumulate capital and wait for pullbacks instead of just thinking about consistently, buying into the market. And I kind of made that switch 3-4 years ago, and it's just it's made my life much less stressful, and two, it's actually provided probably better outcomes, just because if you're consistently waiting, finding the exact right time. Let's say we have a pullback, like even this year when we had March was like a pretty important pullback when we had all like the initial kind of conflict arising in Iran. You don't know when the bottom is, and if you go too early or too late, then you're putting an important decision into your hands where you don't really need to be doing that if you're consistently buying. So that would be my biggest investing habit. Last question that we have from our audience. So I hope I've quoted this properly, but it says, I've recently seen a lot of information on the TER of certain ETFs. What does this mean? And is it taken directly out of returns?
Yeah, that's a great question. TER stands for trading expense ratio. Short answer is yes, it is. What it really relates to is the different type of expenses that a fund or an ETF might incur through trading. So whether it be brokerage commissions, interest expenses, or other fund expenses, it is part of the net return. However, it's already included within the return that investors are seeing. And so it's not something that's going to be an additional cost. But I think there's been a lot more information and clarity that's been provided on TERs in Canada, which has been to the benefit of investors to understand that more.
Yeah, and you know, the TER is also, and it's interesting that they've specifically pointed this one because, correct me if I'm wrong, it's not something that was like, if you know, it wasn't like advertised, right? It was kind of like a little bit hidden somewhere in the fun facts and all that. Is that something that you think, is it because we're changing to more clarity is one of the reasons why this is coming up, or is it simply because investors are getting a bit more savvy and they're starting to dig a bit deeper into this aspect?
Maybe a bit of both. Total cost reporting is something that within the country has been spoken about a lot. And so there's some regulatory changes that I think are leading to more information around it. But at the same time, you know, investors have a lot more data and information that's available to them. Yep. And so I think with that comes that visibility into those additional costs. And, you know, we'll get more into that later. But sure. I think it's a combination of things for the betterment of investors' education.
Yeah. But, you know, even like when you said the short answer at first, like the important part is it is taken out of the return, right? So if you're looking at, you know, whether it's, you know, on an asset manager's website like ours, you're looking at Morningstar, or, you know, looking at any other, data source for your fund returns or ETF returns, it will be taken out of that net, you know, quoted return. So don't think that if you open the fun facts and you see a higher TER than you expected, that like all of a sudden that's being added to or removed from the performance that you've seen. That's already kind of baked in. And it also doesn't necessarily mean that because there's a high TER, it's necessarily a bad thing. It also just mean that you know, especially with either indices that maybe the securities underlying cost a little bit more to trade. Like if you think international emerging markets will generally have higher TERs than say like a large cap US equity product. Also, a very high active share manager, very high turnover manager might have a higher TER than one that's a bit more, you know, kind of long-term focused. One doesn't necessarily mean that you're better or worse off. It's just a function of the way that it's operating. So, okay. That's answering the internet. We've answered 4 questions. I didn't add too many more because I did have a lot of questions for you, and we try to keep these at around 30 minutes. But Jason, let's get into it. But you know, before we, you know, get into the findings, if you will, of your paper and kind of the whole, you know, research aspect of it, is like, how did this topic for the article of performance matters, you know, how did it come about? Like, what's the backstory? Like, did you just wake up one day and say, you know, oh, I want to write a thought leadership piece on this? Or is there some type of backstory to it?
Yeah, I mean, I wish those.
And you don't have to. Anything you can disclose, obviously.
Yeah. I wish those thoughts did just come to me like that. That would be great if it happened. No, I think really, you know, we mentioned that I'm a director in our finance group. I've been with Fidelity for over 10 years, and I've had the benefit to work with a number of different business partners across the organization, groups like our products and marketing team, corporate affairs, HR, and more recently sales. But with that experience has come an education about, you know, the offerings that are available in Canada and globally with respect to investment products. And, you know, we'll oftentimes look at what those options look like for investors and the fees that are associated with them. And when you're looking at those type of elements, the next question becomes, what are investors getting for that fee that they're paying? And that's the part that I think over time became a little bit more crystallized in my mind, that might be the message that a lot of people out in the marketplace could be missing, especially investors who may be a little bit less educated if they're only seeing that fee message out there. You know, more personally too, I've, you know, been working over a period of time where, like you mentioned with those numbers, ETFs have become way more prevalent. And I've seen that with my family and my friends. Yep. And their use of ETFs as well. And so this is a message that, we think a lot about in Fidelity, but I think many investors in their own personal lives would be exposed to also. And so the idea behind the paper was really to think more about what should all of those elements be for what that equation of what an investor should be looking to achieve be.
Oh, very good. Yeah, makes a lot of sense, right? Like you said, it's kind of like it naturally occurs, but then it piques your interest to see like, okay, where is this coming from, right? And I think that's also a very interesting component of it. And I guess you mentioned like of your experience working in like different departments, understanding kind of the obviously different objectives. Each department's got kind of their own objective, but also everybody's working towards the same goal of like launching great products at a competitive price, et cetera. But like, how has your work as a director of finance made you aware and conscious of like this narrative changing? Like, because if you go like, and you said you've been at Fidelity for more than 10 years, so you've kind of seen this change of, fees becoming even more of a sensitive topic than say they were, I think 15, 20 years ago, when it was just about, what's the bottom line here at the end? What am I getting and what am I keeping? So like, how have you seen that evolve or change over time?
Yeah, I mean, I think a lot of it comes down to technology and data that's available. There's so much information out there that's been made available to all of us, investors especially, that wasn't available back then. And that's, it's a really, I think, on the whole, a big benefit for everybody to have a better understanding of the products they're invested in and that information. At the same time as that data has become more available, I think the market backdrop that we touched on earlier has been one where investment returns have been such that, if you were invested in a product that might be more passive and lower cost, you've probably done fairly well. And so that message can reinforce itself into one that only focuses on fees. And I think, frankly speaking, it's probably a bit of both. It's tough to really pinpoint the one thing that's led to it, but it's a whole variety of things. I think that the data and the technology one is a really big one in my mind, though.
That makes a lot. I mean, that makes a lot of sense. You got more access to information. The bull run does not for sure pushes that narrative, because we mentioned it a little bit earlier, but and you can see it from a lot of investors and advisors that we work with, and obviously on our side, like we're meeting with these advisors to constantly things like S&P SPIVA reports, which is like, with the percentage of managers that have outperformed, a given broad benchmark over time. And it feels like the numbers are generally fairly high. Depending on regions, it varies, but nonetheless, it's because those indices have been fairly hard to outperform, because it's been very concentrated leadership, a lot of really strong winners, but then a lot of pretty big losers on a relative basis anyways. But that's not always the case. And so anyways, it's going to be interesting to see how this develops. And you already see it. You see it anytime there's market leadership changes. It feels like you get really kind of a wave back the other way, where all of a sudden it's like, oh, one, risk-adjusted returns, not just absolute returns, is important. And two is there's probably areas that I'm not looking at, or that my index just doesn't have any weight left into it. You can see it just by sector changes. And I'm deviating. I'm making little parentheses here, but like, energy is 3% of the S&P 500. It used to be above 15% prior to the Great Financial Crisis, and it's like, that's a massive change. And if you own an energy fund, it's probably not been great over the last 15 years for the most part, relative to say if you had a tech fund, or if you own just the NASDAQ or S&P 500. So different environments, different situations, for sure. Going more directly into the paper here, there's one of the first quotes that caught my eye, and it's like, I'm probably actually going to steal this for when I'm talking about factor-based strategies versus purely passive, and like why it is in a lot of times worth it to have a little bit, a bit of a higher cost. Is, as individuals, we seem to always generally do like a cost-benefit analysis for any given, like service that we go and receive, or a good that we purchase, whether it's like a car. Like, one car might be more expensive, but it might have a longer range if you're an electric car, for example, or it might be it's much more reliable, much more safe. So maybe it is worth an extra couple grand. Or you go to you're maybe not going to go to the cheapest dentist because you want your tooth to hold on for more than 10 years. So why is it that we somewhat don't really do that for investing? It's like, going back to that point a little bit of cost being maybe a bit too important.
Yeah, it's such a great question. Investment returns change over time, so maybe it feels a little bit less measurable than a toothache, which everybody can identify right away. But I think you're touching on something that is really top of mind for me, which is ultimately not necessarily the fee that you're paying, but the value that you're getting for that fee.
Yeah.
And you miss that when you think only about the fee that you're paying for something. And like you said, there's so many good examples in your everyday life where, yes, you're taking in the fee that you're paying for something, and that might be high or low relative to what you had expected. But if you assign a high enough value to it, you're probably willing to pay that fee relative to something that's cheaper because it's not going to give you as much value.
Yeah.
And I think that, within the investing landscape, that could be a really powerful message, but one that is incomplete with just the fee component being considered within it.
No, I love that. I love the quote, the way you phrased it in the paper. And anybody who hasn't read the paper, by the way, you can find it on our social media platforms. Like we spread the message, we spread the word. You can definitely find the paper there. But another thing, when we chatted last week, we do a little bit of prep when we do these. We're not just completely out of the blue. You mentioned something that I thought was really interesting, which is fees are just the denominator, and in an equation. And so, can you explain that a little bit to me?
Yeah,
and our audience.
Yeah. Happy to. So, I mean, that goes right back to that point, right? So, what do we know? We know the fee that we're paying for something, but when you're making that decision to pay that fee for something, what you're ultimately also doing is making a decision not to pay a fee for something else. And so, if you want to look at it on a relative basis, you can compare the fees of those two options. Say, a flight as an example, and you've got your differential on the fee. But then you need to decide what is the relative value that you're getting between those two. And that could be the numerator of that equation. Airlines, actually, maybe that's a little bit harder. There's certain things that you'd be able to assign to it. But I think when it comes to investment products, we've actually got a really good option right in front of us, which is the return of those two options. Yep. And so what I would suggest is that if you're able to find an investment option where the return is greater than the differential, I should say, and the return is greater than the fee differential, you should be happy to make that choice, because that, all else equal, is a better value for the fee that you're paying.
So performance is the numerator, fee is the denominator, and you get your output. Pretty straightforward. Where does diversification come into this? Because, I mean, it's one thing to look at performance, it's one thing to look at fees, but at the end of the day, it's like you could also have something in there that maybe, like, once again, if we run the equation on it, could be maybe not the best choice, but if you were then to look at it from a bigger picture with, other investments in the portfolio, maybe it makes sense simply from a diversification standpoint. So, like, how have you kind of put that piece into this puzzle?
Yeah, I mean, admittedly, it gets a little bit tricky, but I think you said it really well, that it feels as relevant now as maybe ever, just given with what we've seen. I guess the way that I would think about it personally goes back to that idea of time horizon and objectives. So if I have a longer term objective in mind, maybe I want more diversification, knowing full well that in the shorter term, it might not provide the additional performance. Yep. But I can feel better knowing that even if it's a more expensive option, it would protect in a scenario that I might try to be planning for. I think it does get really tough, but like you said, it's such an important part of a portfolio today, just given with what we've seen, that you definitely don't want to discount the importance of it.
Yeah, no, for sure. And yeah, just if you take three low-cost products that look diversified from the top level, but then you realize they have half their securities are overlapping. Once again, you've considered fees maybe a bit too much over the diversification and or performance perspectives. My next question is around kind of demographics, because we said like this trend is increased. Is this you think younger investors are more sensitive to this reality than, say, maybe more seasoned investors?
I think so. I mean, I'm using my own examples again from my personal life. I think there definitely is a bit of a trend there. Part of it might be what's been your experience with markets. I think, again, touching on the bull run that we've seen, if you skew younger, you've had a really good experience. And so maybe you're you haven't been through as many market cycles that make you more aware of the risk that could be out there. So my guess would be yes. What is your experience with that?
Yeah, no, I think you hit bang on. I think it's you can even see it like you know, in our like everyday roles, like at Fidelity Investments, like a lot of the, you know, associates on our team or analysts on our team, like the worst that they've experienced was like 2022, which was not a great year. Let's be honest, fully honest here, but it wasn't like a full-on credit cycle like 2008, 2007, 2008. Even, you know, the COVID drawdown that we had, you know, 4 months later, we were, you know, at new all-time highs. And so it's like these very short-lived periods where what was at the top drops down, but then really quickly the same leaders emerge, right? There hasn't been this like full-on rotation into other parts of the market where you're like, oh, we're going through a full-on different cycle here, which, you know, occurred from like financials and commodity leadership into more tech leadership post great financial crisis. So once again, like experience matters. So probably I'd agree with you. I think younger investors are probably a bit more sensitive to it because they've had such a great experience investing so far. Last question for you, then we're going to wrap it up, and like time flies by as always when we're recording these. It seems like this trend's been somewhat of a one-way street. And we were poking at it a little bit earlier with like growth on the active side, growth on the smart beta or factor side. Like, what do you think it might take for this to like, could it completely flip-flop? Or is it just like, maybe it's just a bit less relevant in conversations going forward? Is there a switch that could happen? Or
It's a good question. I mean, what seems clear, again, based on the numbers that you've shared, is more and more investors are choosing ETFs.
True.
Whether it be passive or active, the active one has come more recently. It's an ETF that's being chosen. And with that, again, has come more options. And so now I think ETFs as a vehicle are better suited to fit into those needs of portfolios that lead to the diversification elements that we talked about, that lead to longer term horizons with opportunities to beat benchmarks that we talked about, and that frankly might come with higher fees, which we've seen too. So, you know, that'll play out over time. I expect it would probably continue. Barring that, I think we'll see what the next market cycle has, right? We'll have to see how that plays out, but I think it's certainly going to be something that we'll see as a trend going forward to a certain extent.
Awesome. Well, thank you so much, Jason. This has been absolutely awesome, and keep up the good work because we all benefit from it internally, and now you can all benefit from it externally as well. Jason mentioned earlier it was his first time in the studio, and I told him don't do a too good job because you're going to be back here every week. So, but no, thanks so much for joining us. Thank you all for listening in. You are always happy to receive your questions. Please keep submitting them. It's always a blast to answer those. You can catch us next time. We'll be recording back in a month as always. So thank you very much, and we'll catch you next time.